Let's get straight into it. We believe the Fed's pivot to a more dovish stance is a big development heading into 2024. Overall, this is likely to result in more range-bound interest rate differentials and a more range-bound US dollar outcome. Therefore, we suggest investors play this range with a slight bearish bias. The main beneficiaries of this are likely to be the Japanese yen and the Australian dollar. In the short term, technical charts suggest the US dollar is likely to be range-bound as markets digest the implications of the Fed's dovish pivot. Over the longer term, we believe the Fed has shown its hand and will be more responsive to any signs of economic weakness than elsewhere in the world, meaning that the risks to the US dollar are to the downside, especially given its elevated valuation. Meanwhile, the European Central Bank is expected to be relatively hawkish, even in the face of significant economic weakness. Therefore, we believe the market may be pricing in too many rate cuts in Europe. This means the euro is likely to be supported, with the 2023 lows between 104 and 105 unlikely to be breached. In Australia, signs of a stabilisation in China's economic growth profile and sticky Australian wage growth and inflation are likely to delay any monetary policy easing more than elsewhere in the world. This should ultimately prove supportive of the Australian dollar. And finally, our expectation that the US 10-year government bond yield will decline towards 3.5%, alongside gradually tighter monetary policy settings in Japan, mean we expect dollar-yen to be volatile and head lower over the course of 2024 towards 135. We'd set ourselves up to trade the range in the US dollar in 2024, selling into any short-term dollar strength, especially against the Japanese yen and the Australian dollar. That's all for now. If you want the latest market developments and our most up-to-date investment views, please subscribe to our Standard Chartered Money Insights podcast channel, available on Google, Apple, and Spotify.